The U.S. stock market is sitting at a record high with the S&P 500 above the 3,200-point level for the first time ever. But looking ahead to 2020, our next guest is expecting much more subdued returns, and he says the ride could get bumpy. Joining us from Chicago is Paul Notle, Senior Vice President and Portfolio Manager at Kinsview Asset Management. Paul Notle, thank you a great deal for stopping by, as always. What will be the key for investors in 2020?
Yeah, I think the key for investors next year is going to be a return to an old idea of diversification. The last 10 years has really been the decade of the S&P 500. It's been the dominant asset class. But we're just now starting to see over the last 3 to 4 months, we're getting better performance from emerging markets, which are very inexpensive here, international. We're seeing commodity prices even pick up a little bit. And maybe a return to some small cap issues. So just over the last few months, we're kind of getting a whiff that the S&P may not be the only game in town going forward.
2020 is also an interesting year for the U.S., obviously, given it's an election year. How much does the potential uncertainty attached to that also go into your thoughts around non-U.S. assets maybe doing better, just because U.S. is going to have other things to focus on, and there might be some controversy around what happens throughout the course of that process leading up to the election day?
Yeah, election years are fraught with nothing but controversy of late. I think really that's part of the reason for it. The other part, too, is when we take a look historically during election years, those tend to be, out of the presidential cycle, the worst part of the four-year cycle. And they tend to start off slow. We've seen over the last 5 or 6 years, maybe even going back a little bit further, the first quarter being the worst quarter from an economic growth perspective. And then picking up as we get into the later part of the year. So it very well could be the first quarter, first half of the year is going to be kind of rough sledding until we get closer to the election and figure out who the two candidates are, and then who may, certainly when we get to November, who will win and move forward from there.
Which emerging markets do you think hold the most opportunity for investors?
Hard to say. You know, if you look at it strictly from a valuation perspective, the cheapest certainly would be like Taiwan, Russia. But, you know, there's plenty of hair on those markets, and it's kind of rough to wrap your arms around them. We tend to look at a much more broad-based, diversified basket of emerging markets. China has been beaten down of late and certainly suffered from the trade tariffs. And that is a market that looks kind of interesting here as well. But again, we like the broader-based emerging markets as opposed to trying to pick countries.
The strength of the U.S. dollar has been playing a huge role over the years about why the U.S. has outperformed non-U.S. equities in general. Does this also mean that your view on the dollar is we've seen the peak here and we're going to see some evidence of it rolling over?
Yeah, it's possible. I mean, we've been calling for the demise of the dollar for quite some time, and we've been in a very broad camp with that as well. But I think if you take a look at it, it's been 2 steps forward, 1 step back for the dollar over the last 6-7 months or so. We're starting to see that break down a little bit. It's now down around support from a short-term basis. We'd like to see the dollar start to trade down as we, again, see other parts of the globe do better relative to the U.S. And that'll take some time, I think, to unfold.
We've seen a pickup in commodity prices late in the year. Copper and oil both doing better. Gold has done well through the course of the year. What do you see ahead for commodities in 2020?
Yeah, commodities are kind of interesting. Like I said, copper has done very well here. We've seen pickups in sugar prices, coffee prices. It hasn't been just in one part of the commodity market. So again, looking at a CRB or the Bloomberg Commodity Index, again, the same thing. They've noticed a bottom in late August relative to the S&P 500 have been picking up of late. That may go to global growth picking up again in next year, and part of the overall thesis for investing internationally versus the U.S. as we kind of muddle through the election year, other countries faring better than the U.S.
Growth versus value. We saw a pickup late in the year in the value stocks versus the growth story. What do you think how that story will play out in 2020?
Yeah, it's certainly one of the key sectors there. The two key sectors in the finance and the value side is finance and healthcare. Finance should benefit from a little steeper yield curve here. Healthcare has been under fire depending on the day of the week and which political party is talking. But we think that healthcare values provide a good entry point here for the long term, especially when we start taking a look at some of the key areas like biotech, et cetera. maybe not so much the pharmaceutical side. So those two sectors are two that really we watch closely for value to continue outperforming.
There's still lots of trade uncertainty out there, but certainly when we look back at 2019, it didn't hurt the markets at all. Most developed economy stock markets are trading at or near record highs. What do you see ahead for 2020 in terms of the way that the markets react to news, positive or negative, on trade?
Yeah, you're right. Trade has been the headline, but I think below the headline, and what's I think really the reason we're seeing equity markets around the world at all-time highs is because of central bank intervention. We've had central banks cutting rates globally, and that low interest rate environment that we've been very used to since 2009, I think, has gotten investors into the equity markets and pushing those markets higher, anticipating better news ahead from easy monetary policy and not necessarily from a resolution from trade.
There are mixed views out there on how the market will react to modestly increasing earnings from S&P 500 companies. What's your take on earnings growth in the U.S. and how the market digests that?
Yeah, earnings growth for the year is looking to be about 7-8%. Generally speaking, that has been always revised lower. And again, as we mentioned, the first half of the year tends to be a little bit slower than the back half. Earnings actually from a GAAP perspective are down or will be down, estimate for fourth quarter versus fourth quarter a year ago. So growth is going to be slow. The main driver for the markets this last year is PE expansion. We need to see earnings pick up in order for the S&P to continue to do well, as PEs, in our view, are toward the top end of their historical range and will struggle, I think, to expand from here.
Paul Notle, Senior Vice President and Portfolio Manager at Kingsview Wealth Management in Chicago. Thanks a lot, Paul, from Chicago, and happy holidays.